Yeah, it was the worst 20-year auction perhaps in history, from the way that I look at it. In fact, I think it is the only the second. Let me put it this way: it maybe the first or the second highest yield for a 20-year bond auction in history. There may have been one other. I read about it an hour or two ago, and it talked about it being over 5%. And I could have sworn it said it was the worst in history, if not the second. And, you know, you're witnessing, whether it be here or in Japan or in the UK or all around the world, the bond markets are in very big trouble. I think the concept of owning debt from an insolvent country, one that is irresponsible with their fiscal policy, even in the face of Doge, asking to raise the debt ceiling once again. This is emblematic of what we just saw just the other day, where the Fed had to come in and quietly, in what they call stealth mode, I guess, where they're not calling it QE, bought 43.6 billion worth of treasuries in 1 week, 20 billion in 3-year, 34.8 billion in 10-year, and 8.8 billion in 30-year. The Fed is coming in because no one wants to buy our treasuries at these levels, and you can see it here on the 20-year. That's probably why the market turned around and threw up the way that it did. And you can look at the Japanese market, same thing. You know, I think there is a certain segment of the Japanese population, forget about the unwinding of the Japanese carry trade. I mean, that's very detrimental in and of itself. We saw what happened a month or so ago when rates in Japan first started to move and everything calmed down, but here they are moving up again. And I think one of the reasons you're seeing gold catch a bid is partially because I think there are a lot of traders in Japan who figure the BOJ is going to have to turn around and go back to yield curve control, which should be very, very bullish for gold. But what you see happening here is an interesting phenomena. You know, the Fed is trapped between inflation and keeping rates down. I don't know how they'll do both, but you can see the market perhaps is even stronger than the Federal Reserve. And what's really interesting about all of this is that gold is moving up in the face of rising interest rates. Now, we're always told that rates go higher, gold goes lower, the inverse correlation between the two. But when you factor in what or who's issuing the debt, you know, I was listening to a Bill Fleckenstein interview, and he said, you know, on Wall Street, we used to call that a who-to problem. Who do we sell it to? And I think that's the issue, is that, you know, we're finding a pool of a diminishing pool of interested parties to buy our treasuries. And it's funny, you see China, who is now slid to number 3 in treasury holdings, replaced by the United Kingdom. Vince Lancy had a great analogy. He said it's like two drunk guys holding each other up from falling. You have, you know, the largest debtor nation buying debt or selling its debt to the second largest debtor nation, or real darn close to it anyway. So two broke nations buying each other's debt, as the rest of the world seems to be favoring things like commodities and cryptocurrencies or whatever the heck they can get their hands on that are tangible, copper or silver, gold or platinum, which we saw a microcosm of a short squeeze yesterday and a little bit today. And I think that's on a larger scale what you could expect to see in the silver market. But yeah, it's an interesting time right now. And certainly I think it focuses squarely on the bond market. That's where really the trouble lies. And the question being, you know, you raise the debt ceiling, you go around the world imposing tariffs that in many respects are actually sanctions masquerading as tariffs. You continue to spend irresponsibly. And the world at some point says, you know, we just don't want to purchase your debt anymore. And maybe that's kind of part and parcel what Zoltan Pozsar was talking about, this move to Bretton Woods 3, a system that will move away from promises from an opaque debt system. And if you think about the concept of buying someone else's debt, another country's debt, and calling it an asset, it doesn't have a huge history compared to things like, tangible assets. And he said, that's where we're going, a system that will be transparent, like blockchain, and one that will be backed by commodities. And, the old saying, he who has the gold makes the rules. Well, that's exactly what President Trump said on Easter Sunday in a tweet, which is interesting. With the amount of gold coming into the Comex, the largest deliveries in the history of the Comex in the May contract, over 16,000 contracts, that's $5.3 billion worth of gold delivered in the May. That's over a 700% increase year over year from this time last year. But this is every single month we're seeing it, and it's not stopping. And I think you're seeing a lot of players that are choosing physical gold in your possession, which is outperforming the bond market as an alternative to it. It's not just here in the United States, it's everywhere, and even in places like Japan. So yeah, this is just beginning. We'll see how it all plays out. We've all lived under this belief that these types of issues will always be resolved and papered over, and they always have been, I guess, maybe until they're not. But right now, these are certainly interesting times.
Well, in addition to that, and don't tell me if you touch on this, was the downgrade of the U.S. debt, because that factors into appetite for the debt as well.
Yeah, and it's funny, they talk about, I don't know why they decided to do it now, right when you have an administration actually addressing the irresponsibility and the corruption in basically the evisceration of our currency through ridiculously irresponsible programs that the government has spent our money on. Now they want to do it, not before this. I think Moody's is kind of nonsense, to be honest with you. But they talk about a warning of a debt to GDP hitting 134 by 2035. But the truth of it is, if we add in the unfunded liabilities, we're well north of 200. And, they say an interest burden will consume 30% of the revenue by 2035. Up from 9% in 2021. Well, the Congressional Budget Office also said by 2031, every penny of tax revenue will go just to pay the interest on the debt and these mandatory off-balance sheet entitlements, Social Security and Medicare as an example. So anything that's discretionary, like military, which is $1 trillion bill this year, will be borrowed. And at what point do we realize that the world has lost appetite for the treasury? So who's going to buy it? It's that who to problem again. Who are you going to sell it to? And when you see the Fed come in and not even admit the fact that it is quantitative easing, that they are buying treasuries, and they do that, they're trying to plug a hole in the dike to keep the bond market together and to keep this from accelerating. But this is a real problem. At some point, the irresponsibility catches up with you. At some point, the way that we behave on the international stage, the tariffs, the threats, the sanctions, the spending, the borrowing, the raising of the debt ceiling, on and on and on. At some point, I think the attractiveness of our debt looks silly. And anyone who would hold duration of any length greater than 6 months or less, I think is a fool in this market right now, and the bond market is proving that to be true. And again, it's really interesting that as rates are going up, so too is gold. Gibson's paradox speaks to the inverse relationship between real rates and the price of gold. And as rates continue to rise, even if we have to suspend the fact that we know that the CPI is a bunch of crap, but let's just take it at face value. That's what the market uses. Well, as the rates right now are certainly over the CPI, that is a return, a real return. One would expect that gold, which does not pay a real return, should be retreating. And one of the hallmarks of this market that is vastly different, Dunnigan, than anything I've seen in 35 years is, it's kind of like a fight in high school where, you hit the kid, he never gets back up. You're watching two kids fight. One hits him, he never gets back up. But this time the kid keeps getting back up. He gets hit and he gets back up. He gets hit and he gets back up. And I've never seen that before. Maybe that's a bad analogy. But the point of it is that they never did this. It would get hit and it would be down for years and sometimes even longer than that. And you look at 2011 when it hit $1,900 and it was down for a long time. 8 years. or so, 7, 8 years before it finally came back. And but this time seems to be different. It goes down 100 or $200 and comes right back up. And the demand in Asia is overwhelming. And you can see it. It's almost as if the Chinese now are controlling the price of gold. I don't think they are with silver yet. But there was a very interesting tweet by Eric Young. I don't know if you've had him on your show. You should if you haven't. He's the King Kong on Twitter. He's phenomenal. He lives in Hong Kong, I believe. I've had him on mine. He has a very, very interesting take on things. And today he basically said China's involved in all of this too, suppressing the silver price because they're trying to accumulate every ounce on the planet. Think of them going around buying the doré and the concentrate, as we've talked about. And what he's basically saying is that they're thinking for years to secure supply for their country for future generations. He said, just hold on, you'll see silver be triple digit, don't let go. So interesting times for sure.
We've got also a topic to talk about, and that's the ECB comments on leveraged gold market and the potential fallout from that. That's something that a lot of people are concerned about. What do we know?
That is one of the craziest things that I've read in a long time. I'll read it to you. You know, the EC is one thing for you and I to say all of these things, but it's another thing to hear it from the ECB. It talks about vulnerabilities have arisen because of commodity markets tend to be concentrated amongst a few large firms, often involving leverage and a high degree of opacity deriving from the use of OTC derivatives. Margin calls and the unwinding of leveraged positions could lead to liquidity stress amongst market participants, potentially propagating the shock through the wider financial system. Additionally, disruptions in the physical gold market could increase the risk of a squeeze. In this case, market participants could be subject to significant margin calls and or have trouble sourcing and transporting appropriate physical gold for delivery in derivative contracts, leaving themselves exposed to potentially large losses. Well, that sounds like what we've been talking about for a long time. And that's, you know, look at the LBMA, 8 weeks delivery on a T+1 exchange, opaque. Yeah, no one knows what's going on there. And the leverage that these physical gold market participants are engaged in, that's exactly what they're saying. You have them coming out and saying it's a threat to the entire system. Well, you're darn right it is. And this is what is being exploited by much of the world right now because they understand just what we're doing.